So preferred stock is another class of stock, and it has a preference for dividends, and also it'll be paid before common stockholders in the event of liquidation. So the dividends that are going to be received by the preferred stockholder are stated in the description of the preferred stock. So the preferred stock may be listed as $2 preferred stock, and that means that each share will receive a $2 per share annual dividend. The dividends may instead be stated as a percentage. So in the description of the preferred stock, it will be a certain percentage. And that percentage, it gets multiplied by the par value to determine the annual dividends. So if it was 2% preferred stock and the par value was 100, 2% times 100, that would also mean that the preferred stock is receiving $2 in dividends each year. The most common type of preferred stock is cumulative preferred stock. And this means if the preferred stockholders don't get their set amount of dividends in the current year, those dividends will carry forward to the next year. Those are called dividends in arrears, the dividends that carry forward. And so the preferred stockholders need to be paid their current dividends plus any dividends in arrears that have carried forward before the common stockholders can receive any dividends at all. However, once the preferred stockholders are paid in full with their dividends, then any dividends that the corporation can pay in addition to that all goes to the common stockholders. Non-cumulative preferred stock means if dividends aren't paid in the current year, they're lost. They won't carry forward. And so the terminology a lot of times is that the dividends were passed. So that means they weren't paid. So here's an example. We've got a corporation, 2,000 shares of $100 par, 6% cumulative preferred stock. And then we also have 16,000 shares of $10 par value common stock. So since it's $100 par 6% preferred stock, the annual dividend is 6% times 100. That means each share of preferred stock will get $6 of dividends every year. So there's 2,000 shares of preferred stock, so that means the corporation should pay $12,000 in dividends to the preferred stockholders every year. They didn't pay dividends last year. The dividend was passed last year. This year, there's $30,000 in dividends that have been declared. So that means the preferred stockholders should be getting the $12,000 annual dividends that they're supposed to get every year, plus there's $12,000 dividends in arrears. So that means $24,000 will go in dividends to the preferred stockholders. Then the preferred stockholders will be paid in full. So the rest of the dividends, the rest of the cash that's available to pay in dividends, $6,000 will go to the common stockholders. Okay. Our next topic is stock dividends. Okay, so stock dividends, again, we're rewarding the shareholders for the profitability of the company, and we're going to distribute shares to the stockholders. And so think about it. A dividend makes retained earnings go down. Distributing shares means the contributed capital or paid-in capital goes up, common stock and the paid-in capital in common. So we're really just going to be shifting amounts between stockholders' equity accounts. So our total stockholders' equity will stay the same. Now our market price is going to change. There's going to be more shares outstanding. What's going to happen to market price? Right? If we look at my analogy of a piece of the pie, if we have to cut more pieces of the pie, that means every piece is going to get smaller. So when there's a stock dividend, the market price of the shares will go down. But the stockholder will have more shares that they can trade. So GAAP distinguishes between a small stock dividend and a large stock dividend. A small stock dividend is less than 20 to 25% of the outstanding stock, because the board will declare a stock dividend in terms of a percentage. So they will be distributing a certain percentage of the outstanding stock, and every shareholder will apply that percentage to the number of shares that they're getting, and that's how many shares they'll get in the dividend. So less than 20 to 25% of the outstanding stock has been declared as a dividend. It's a small stock dividend, and we will account for the stock dividend at market value. That means the market value will be coming out. The market value of the shares that we're giving in the dividend will come out of retained earnings. A large stock dividend is greater than 20 to 25% of the outstanding stock. So then we will account for the dividend at par value. The par value of the stock being distributed is the amount that's going to come out of retained earnings. If you're in between 20 and 25%, then I guess the corporation can decide for themselves if they want to treat it as a small stock dividend or large stock dividend. So, a small stock dividend. We will debit the stock dividend account for the market value of the shares that are going to be distributed in the dividend. So we'll debit stock dividend, and we're not going to credit common stock because we're going to declare the dividend and then the shares won't be distributed until a point in the near future. But we're going to use this account called common stock dividend distributable. This is going to be a placeholder account because the amount is going to eventually go into common stock when the shares are actually distributed. So the common stock dividend distributable is going to be calculated the same way you calculate the credit to common stock. It'll be the number of shares in the dividend times par. And then the difference between the market value and the par value is going to go into the paid in capital in excess of par. A large stock dividend, we will debit stock dividend for the par value of the stock dividend, credit common stock for the number of shares times the par value. So that's why you will not have a paid in capital credit in a large stock dividend journal entry. The date of record, again, it's just to determine who's going to actually receive the shares from the dividend. We will not make a journal entry. And then the date of distribution, we're just taking it out of that placeholder account, common stock dividend distributable, and crediting common stock for the amount that we used in the journal entry when we recorded the declaration. So here's an example. The board declares a 5% stock dividend. There's 10,000 shares outstanding. The market price is $10. We've got a par value of $2. The number of shares in the stock dividend, we're going to take the 10,000 times the 5%. So we are going to be distributing 500 shares in the stock dividend. That's what we're accounting for in this journal entry. So we'll debit stock dividends for the market value of those 500 shares in the dividend. So we'll take 500 times the $10 market price. Debit stock dividends for 5,000. We will credit common stock dividend distributable for the number of shares in the dividend, the 500 shares, times the $2 par. So that's 1,000. And then the difference goes into paid in capital common of 4,000. Then when we distribute the dividend, we'll be taking it out of common stock dividend distributable. So here we can see we credited common stock dividend distributable 1,000. So we'll debit common stock dividend distributable and credit common stock. Stock dividend distributable is part of paid in capital. So if we come to the balance sheet date and we still have not distributed the stock dividend, we will list stock dividend distributable as part of your paid in capital. Stock dividends will be closed into retained earnings the same way cash dividends is closed into retained earnings. So let's take a look at ownership percentage. So before the stock dividend, let's say there was 10,000 shares. If an individual stockholder owned 1,000 shares, then that meant they had a 10% ownership of the corporation. Well, then they issued an extra 500 shares. So then there were 10,500 shares outstanding. Since this individual stockholder owned 10% of the shares, they got 10% of the dividend. So 500 times 10%, this stockholder would have gotten another 50 shares in the dividend. Now that individual stockholder owns 1,050. So 1,050 divided by 10,500, that stockholder still has a 10% ownership. And that's what should happen, is all of the stockholders maintain their ownership percentages. Okay, so along the lines of a stock dividend is a stock split. And this is done when the price of the shares of stock gets really high, because the higher the price of the stock is, if you have a block of shares that you want to sell, it's going to be a large amount. It's going to be harder to find someone to buy them if you're trying to move a lot of shares. So what corporations will do is they'll have a stock split. So let's say it's a 2-for-1 split. That means every share gets split in two. So if you had one share, now you have 2 shares. And so if we double the number of shares, the market price is going to drop. Initially, it'll drop to half. And then it'll be easier to trade your shares of stock if now the stock price is half. And I think when we were looking at Amazon, their stock was over $1,000, right? It's hard to move a bunch of shares. If you wanted to sell, 500 shares of Amazon stock, right? That's $500,000. It's hard to find somebody with $500,000. So if Amazon had a stock split, right, a 2-for-1, now all the shares are worth 500. That's still pretty expensive. But that's what happens. We're increasing the number of shares, and the par value is going to be reduced in the same proportion. And you're going to see, at least initially, the market value is also going to be reduced in the same proportion. However, if the market, it's a strong company, the market value will rise again. So that's how people who invest in these companies early on, that's how they become multimillionaires. If you would have invested in Apple, or people that invested in Microsoft back in the day, they bought the shares when they were, inexpensive. They were an up-and-coming company. And then over the years, the stock has split many times. So now these companies, or these individual stockholders that had a few shares to begin with, now they own thousands of shares, and the price keeps rising back up again. That's how people become multimillionaires with these companies, getting in at the beginning. So when there's a stock split, the stockholder's equity account remains the same, because all that's changing is the par value and the number of shares. Okay? So we don't have to make a journal entry. Oops. All right, so the new number of shares. Take the number of shares before the split, multiply it by the amount of the split. I said it could be a 2-for-1 split, it could be a 4-for-1 split, it could be a 5-for-1 split. So we'll multiply it by the amount. 5-for-1 split, we multiply it by 5. And that'll give you the new number of shares after the split. The par value is going to be divided by the amount of the split. So a 5-for-1 split will divide by 5. So let's take a look at this. We had a corporation, 10,000 shares with a $4 par value. So the common stock account, 10,000 times 4, the common stock account had a $40,000 balance. Well, it was a 2-for-1 split. Multiplied the shares by 2, we now have 20,000 shares. Divide the par value by 2, now it has a $2 par. 20,000 times 2, and the common stock still has a balance of 40,000.